Greetings guys, I hope you are doing well. So in this short video I want to answer a few questions that I have received from you guys. But before we start, let me remind you that I'm not a financial advisor, so do not use anything you hear from my content as financial advice. So the question that I've been receiving from you is differentiating model A from model B, the differences. And I have also received questions that you need examples on model B precisely. So let me remind you that model A is actually a reversal model. It's when price has taken the buy side or the sell side, and then you take the reversal, like I have shown you guys in my previous videos. So, and but then on the model B is a continuation system. You don't trade. It's because trading the reversals is kind of a little bit difficult, especially if you don't know when price has truly grabbed liquidity and then we're in the reversal. So people get taken out multiple times before price reverses. But then I've seen quite a number of you that were able to grasp this model A. Model B is for continuations. You wait for price to take it to run on stops, you wait for the reversal to happen, and then you wait for price to um to create an order block. The order block will be created by price running on stops again within the trend. Okay, because the reversal happens at the end of the trend, but then the continuation, which is model B, happens within the trend. So price will grab a liquidity, and then after grabbing liquidity, it will create the order block. That order block is your entry when price is retesting it. All right. If I can draw again something really quick, this is your buy side, your sell side. You had price come down, taking that liquidity. We take a high, confirming that we are reversing. Okay, price has to take out the previous high, the previous structure, okay, for us to confirm that we are having a reversal and up like that. So now what I teach is this structure that has been taken from here to here. You wait for that 50%. This is what I've been teaching for, I don't know, over 2 years, I think. Okay, I used to add 62% here. Why? Because I would put my stop loss below 62%. But because you guys are beginners, I would advise you, when trade this reversal, put your stop loss behind the structure. In that way, it's well protected. All right. Now, some of you, what I've been noticing is that you don't understand what a reversal is. What I'm saying is, when price does something like this, okay, like this, and then when price takes this high, you refer to this as a reversal. It's not a reversal. Why? Because even though it seems like it's a previous structure, it is not equal to this one here. You remember I taught you how you recognize a valid structure and an invalid structure. So the only way price is going to have a reversal is when we take out the major high, the major previous high, like that. Okay. Another thing I've been seeing that you guys are doing wrong is that when price will do something like that and then come down, create equal lows, and when we take this high and then you trade this as a reversal, that's not how it's done. You should go back to my old videos. All right, now when price takes the previous high like that, you have your model A. This is your model A. Price takes a high, makes a low, this becomes your model B. Okay, you see that price has reversed. We are targeting the buy side of the curve, but then price has run on stops. And remember, if you watch that video, we need one candlestick here. We don't need multiple candlesticks. If you're on the 5 minutes time frame, we need one candlestick because an order block here has to be one candlestick. Then we will need price to create one candlestick here, and then price has to go up, take out that candle that went through this pool of liquidity, and once it's being retested, watch my previous video, that is when we make our entry to go up. I swear to God, this is at least over 70% win rate. I can't emphasize this enough. This this is you need to backtest, guys. Okay, so now the question is, how do we identify liquidity? Hey brother, you will know that I'm referring to you. You asked me this question. I don't know how to identify the next pool of liquidity. It's easy, all right? When you have the previous day, this part is this part is the previous day. You have this demarcation in here. Now, let's say price just opened, okay? When the price just opened for the new day, your question should be, where is the next high and where is the next low? Like that, we have a high and low. So your question is, price has just opened, where is the next high? It's here. Where is the next low? It's here. So if we are in a bullish order flow, it means that price is likely to take out the next low before we could go up. I'm going to illustrate it right here. For example, I'm going to answer. Then there is this brother who took a loss here trading gold. This is gold on Friday. This is Friday, so I'll use this feature here. Okay, and let me just take out Friday and I'll leave one. Okay, like that. Now this is Friday. If I check from the daily, listen brother, you took a loss here, so I want you to pay attention because I'm answering your question in this video while I'm also answering other questions. So now, what is the order flow on the daily? We see price is bullish. Price is bullish on the daily. Can you see that? It's bullish. So are we looking for sales? No, especially as beginners, we're not looking for sales. We have to move with the order flow. The essence of the SMB market structure theories and liquidity theories is to move with the market order flow. When you find the order flow, you're not trading what I teach. So the order flow is bullish. Check on H4. Okay, pay attention, brother. I'm answering your questions. What is the order flow? The order flow is bullish. What do you see? What I teach in my videos? We have a high, a low, a high, a low. All right. H1, what do you see? It's the same thing. A high, a low, a high, a low. We put in a high, we put in a low. So now, let's say we move one candlestick. We just opened for the new day. This is Friday. Okay. Now, this brother went on M30 and caught and said, okay, we have this grab of liquidity. Okay, but anyway, I'll show you what was in his mind later. So now, as some prices are just opening for the new day, you should ask yourself, where is the next low between? This is where price just opened. Look above and below. Where is the next draw on liquidity? On the sales buy side, we have this high. On the sell side, we have this low. But what is the order from the market? We are bullish. So what are we likely to attack first? We are likely to attack the sell side. Okay? So there, we just opened. Now let's see what price did. There you go. We just took this low. And now, what this brother did, he went on M30 and said, a grab of liquidity and a breaking structure. This is not what I teach. Price does not reverse this way. It has to take out the previous valid structure. This law is the valid structure. We need price to break it and then continue moving downwards, and then we'll conclude that price is reversing, the trend is changing. Where is the next the previous structure? We have a high, a low, a high, a low, a high, a low. We put in a high. So this low is not the previous structure to be taken out, it's this one here. So we do not have a reversal. Okay, we do not have a reversal. Watch my videos, especially the ones that I uploaded when we had a Zoom call, and there's another call on Skype. Okay, so that was not a reversal. Now, for those who are asking yourselves, where is the next draw of liquidity? This law is protected because this is the valid law. And now price has opened on the new day. Where is the next high and the next low between the opening price? It's this high and this low. You see that? All right, let's keep moving. Let's see what happened. Now, this is the order block. Remember, I told you it has to be one candlestick. One candlestick. If we see multiple candlesticks, those are not order block. When price is grabbing liquidity, it's a tap, a small move, mostly by one candlestick or a wick above an odd high or an odd low. Price is touching the order block. There you go. Look at that rejection. When price touched the order block, what happened? Price went up for the buy side liquidity. You see that? Now, this is the reversal. We just had a reversal. This is the next pool of liquidity. What about the reversal happened here? What about for those who can't trade the reversal, which is the model B, which is the model A? Here is your model B. We wait price to reverse. Now when price moves below a a low like this, grabbing that liquidity, we wait for price to go above the candlestick that they grab that liquidity, which will be what? The order block, the bullish order block. There it is. Boom, this candle When it opened, it touched the order block and we continued higher. Where is the other another example here? We go below this low, we can move on the lower time frame, even up to M1, and you will see the same thing. Same thing. Right here, we go below here. Secondly, the second time, your entry was, you see this candle here that went through it. We wait for price to break it, and then the retest on this week is our entry. We are not trading reversals, we are trading the continuations of the trend which started down here. But the one who entered at the reversal is sitting right here. This is where the reversal traders are sitting, and those who said I can't trade reversal, I want to trade continuations, you are entering within here because this is H1. But when you switch on lower time frames, you will find price will keep taking lows multiple times. Okay. I'm sorry. Okay, here is another one. A low is taken. Let's go to a much lower time frame here. You see that? It's more visible on M5. If you must see, we have a down candlesticks. We have this candle that went through it. Boom. That's the order block. We wait until it's broken. This is the high of that order block. Plus retested here the order block, and then we continue going up. These are simple stuff. All right, but do not fight the trend by all means. This is the same thing. Even on the daily, you have the same setups. A draw on liquidity. Price just took a low here. This is good. And which candle went through these sell stops? It's this one here. So wait for it to be broken. This is the true order block. Once it's broken, it's retested here, and look what happened. Now, this is the reversal, but for those who can trade reversal, when you go in here, you will find the model B. I'm sure there is. Let's look an example. Let's find an example, maybe M15. I'll remove this so that can be clear. There you go. There you go. The reversal, remember, happened down here. And when you go on the lower time frame, because you already know price has reversed, we go below the low. Let me go on M30. And what happened? This candlestick that went below here, the third candle becomes your entry. In this case, price didn't come to touch the order block, but even if you entered just on the third candle, no problem. You see, price just went up. Okay, by simply trading based on, you can see here, price never came to touch the order block again. This is the order block. This is your entry, but it didn't come to retest the order block. So you can decide to leave it, to skip this trade, or to take it as a risk. All right. And what about here? Same thing. Here, this candlestick that went through is the order block. Price retested, your entry is down here, your second entry is here, and you see that price keeps going up. Why do you trade these continuations? It's because price has already done the reversal, and all you are doing is to start to go in the trend and move with the trend. So I hope this has answered your questions, guys. I'll try to make another video because I'm rushing now. I need to go somewhere. So until next time, guys, be safe.